All right, good morning, everyone. Welcome to the trade findings and adjustments for Hurley Investments on Thursday, September 26. If I was to ask you today, well, let me just put it this way. Not if I was to ask you, how would you describe the market that we're in? How would you describe the market we are in? No right or wrong answers. Volatile. There's one. There's two people said volatile. Volatile. Headline driven. And most people say headline risk. Headline driven markets. Slowing economy. Good answer there, Mary. We have a lot of movement, right? Right now we have a lot of movement and a lot of perceived risk. Now, what I mean by perceived risk, ooh, and I like this one too. Another one just came in. Impossible to predict. And Lee, out of curiosity, is your phone working so I can give you a call after? So, really, I agree with all those statements. When I say a lot of perceived risk, it starts with something like looking at the S&P 500. We've had a wild couple of weeks. In fact, I could probably go more to something like this. This is going to be a better explanation. Excuse me. So here we are. In 10 days, we were at 299.7, 2,997. Today we're at 29.69. So we're down. If I'm just going to use a calculator because that way I don't ever make a mistake. 2,997 minus 2,969. We're down 28 points. Not even 1% in the last 10 days. Yet the perceived worry is ridiculous. There are a lot of people freaking out. Well, Kevin, no one mentioned this. Kevin, we have impeachment proceedings, and you didn't necessarily add more protection, right? Kevin, we have a president being impeached, but you didn't add more protection. Why? Why might I not have cared too much about impeachment proceedings? Why did I not double up or triple up or put more protection on Marvel or Baidu or what have you? Why not? Why did I not dump positions like crazy? Wow, there were actually 3 good comments just brought in here. First one that came in, the length of the process. True. The length of the process doesn't mean you have to overreact yesterday or the day before. It's an inquiry. So I think what you're meaning there is just an inquiry. It's not a formal proceeding, if there's a difference there, but you are correct. Right now, it's just an inquiry. And the third one, because he's innocent. Yes, I feel that way, but that wasn't part of my decision-making process. All right, here we go. The why, right? The why. The why comes down to because I remember and studied the past history of 1998. That was the last time Clinton was impeached. Impeachment proceedings don't happen all the time. But the next day, the market was up, which was yesterday. The next month, the market was up big, and a yearly bull run occurred. Yes, I understand it's not the same every single time. I get it. But if you can't remember past history, with all due respect, get your butt out of the market. Well, Kevin, it's hard to remember. Well, if you don't remember it, go study it. Go learn. Learn something, for crying out loud. You can tell I'm frustrated with someone that kind of freaked out. What they should have done is learned. But each has their own choice. If I was to look at my portfolio, probably wouldn't be placing any new trades, but there are some things that I am worried about. As I look at my portfolio, I noticed in these proceedings or these issues, right? I have two positions that right now I would be considered over leveraged in. And I would also, if I took a look at those positions, looking at a cost basis, I have two positions that for all intents and purposes are half of my portfolio. So two positions I'm over leveraged in, which hurt in wild down days. Kind of neat. The Dow's down 0.4, 0.5% for the S&P, almost 8/10 for the NASDAQ. Today, I'm positive. Overall, I'm down, well, overall I'm down about 15,000 on a basically $11 million portfolio. So I'm okay looking at today. But on a personal level, my portfolio is over leveraged in Baidu calls. I've got 5. So I need to take a look at deleveraging my portfolio, even if it's going to be at a bit of a loss. Yes, I've got June 2020 calls. Yes, I'm most likely going to have a pretty significant bump up with any kind of China deal, but I'm way over leveraged. Really, to have an option position be more than 20% of your portfolio, gives you 5 chances to get it right. And I've got it more at 25% of my portfolio. So to lower that down, I can choose to close it out right now. I might choose, though, a little bit different position where at a break even on one of my contracts, I need to exit it. No brainer. Well, Disney, I only have 2 calls. We're out to January 21, 140. But again, I'm at like 27% of my portfolio with this one. This comes into a tricky situation. In all reality, I probably should close one of these as soon as possible. I do have a bit of time. I've got quite a bit of time. Not that I don't have time in the other one as well, but I need to look at this and think, all right, got to be smart. Got to be smart. Can't be too over leveraged. Got to be smart in what I'm looking at. It would be smart. Because well, short answer is I've got some money that I need to come and bring into this one to be smarter with it. But yes, got to be smart. Got to look at ways to increase this. So in all honesty, it would be smarter for me to probably close one. 1385 at probably that $16.50 area. Or I've already got them in play and I'll be ready to get out as it gets there. Now, I know you're going to tell me, Kevin, can't you make more money? Maybe. But a profit is a profit. And obviously on Baidu, I think I've dollar cost averaged these suckers like 1-2 times. It's interesting because perceived risk. I'm trying to make a quick little 5 to 10 minute video on gambling versus trading. But perceived risk. Risk should be defined prior to placing a trade. Which means if you want to risk $2,500, but you are planning on dollar cost averaging, your initial trade should probably only be $1,000, giving you 2 times the dollar cost average at $600 or $700, you know? A lot of times I see people put a $2,500 trade on, and then they dollar cost another $2,500 once or twice, and before you know it, a $2,500 trade becomes a $7,500 loss. Something to think about. If you're going to place a trade, then you need to think wisely about it. If you're planning on dollar cost averaging, you better have that incorporated into your plan ahead of time. There's a couple people that were trading Verizon. So let me do a favor. Let me take a quick peek at Verizon. I understand someone had a 6360 bear put. Is that correct? A 6360 bear put with like a 63-cent cost basis. So if you're here, go ahead and type that in. Let me know that I'm mostly correct there. And the question that was brought to me was, Kevin, I expect it to go down. Well, yeah, it's just about oversold last time it went down. It's up there. It came down yesterday looking good. So if it's a 6360 bear put, you're probably in pretty good shape. You're probably in pretty good shape. Excuse me, bear call. Excuse me. Correct. You're probably in pretty good shape. Because if you spent 60 cents and right now it's worth 75 cents or more, you can get out with a 10% profit. Remember, if it's a bear call, nope, you can't. It's a bear call, excuse me. So it's a bear call, you're waiting for time decay. If it's worth 75 cents, you're upside down. So let me just make a quick comment on this particular trade. Expectations are yes. Expectation, it probably should come down, but the problem is Verizon has their earnings coming up on, I think, the 25th. Pretty sure Verizon has their earnings coming up on the 25th of October. 25th of October. So technically your trade looks good, right? Technically the trade is, hey, we're up at oversold. Last time it happened, 2 times ago, we came way down. Hey, it hit here, we came way down. So yes, your expectation is, can you get through this weekend? Can you get into next week? On the bear call, 60 some odd cent credit, you're looking good. But if you don't get that time decay and that movement down and through the end of this week into the end of next week, I would be exiting the trade the end of next week no matter what, because you will probably run into a bull earnings run. Verizon's up to some all-time highs here. It looks good. You might get a run or a push into a pre-earnings bullish run. So the idea or thought process is, how long can you hold on for time decay to occur for this to go down and test really 59.50 is where it's probably going to test it. You can see, in all honesty, there's a big or a wide discrepancy between the 50-day and the actual price. That deviation is huge, and you would expect the stock to come on down. But if by next Friday, not this Friday, but if by next Friday you haven't gotten some bleed off or some profitability, it's probably time to exit your trade, because you're going to run into a pre-earnings run where people start to get excited about where the stock can go, buy it haphazardly, don't do their work, and that's how you get those usual pre-earning runs. The hype of earnings creates a euphoria where people will start to buy into the stock. So even though you might be in a bear call now, your 60 to 65 cent credit is upside down. by 20%, and that's 70-78% range. You're trying to hold on through this week and this weekend to get some good time decay. You're going to enter October next Tuesday. And in all honesty, with the run up, I would expect to see a sell off on Friday or Monday at the end of the quarter. And at that point in time, look to exit this trade no later than next Friday, which would be October 4th, before you run into a pre-earnings run. It sometimes sucks to place your trade, have it moving the way it's supposed to, and volatility jacking up your price. I get it. But this is where it comes back down to having the mental fortitude to stand by your convictions. And really, that's one of the keys to trading. In fact, one of the big differences between gambling and trading is having the strength to do your due diligence, to stand by your trade, even if the start looks somewhat bad. The comment was just made to it expires October 4th next week. Awesome. You're going to get some serious time decay going over the weekend. I would still be looking at this trade because of the big deviation. Technically speaking, you have every reason to believe you'll exit your trade profitably. And you'll go through some big time decay Friday, Saturday, Sunday, and opening up on Monday. You also have Friday, if not Monday, that you'll see a pretty good sell-off in the market as portfolios are rebalanced. With the run-up that they've had from 57 up to 61, 8%, in a little over a month. For the quarter, boy, some people could have gone at 53. 53 to 60 is a 15% run. Nope, it would have been 54-ish. 54 to 60, a $6, over a 10% run. I would expect to see a little selling occur, and you'll be in good shape. So short answer, stay with the plan. Definitely, obviously, get out by next Friday, but expire so it doesn't matter. And your decision-making process will come next Monday or Tuesday. You're going to get some great time decay over the weekend and the selling of funds that should help this trade out significantly. You're in a good trade. Technically, it makes all the sense in the world. And it's just hard when you get a little drop in volatility that a great position trade ends up being a little upside down. So stick with it. My my registered investment licensed bond insert advice, stick with it. Something to worry about more on Monday or Tuesday of next week. Guys, appreciate you being here. All I really wanted to show you today was rebalancing or looking at a portfolio, correctly judging your risk, as well as going over a Verizon trade. In all honesty, is it a 63.60? Is that the position that you're in? A 63.60 Verizon 1 week trade might be a very smart short-term trade going out to October 4th. Let's see if I can replicate this one. Let's see if we can replicate it. What are the strike prices? You said bear call, but you'd be wildly profitable in a bear call. Do you mean it's a bear put? Bear call, you could exit the trade right now, profitable. Right? Nope, you couldn't. But you're close to being able to. I get it. Looking it over. To get 81 cents here wouldn't be a bad trade at all. Short-term trade. 60-63 bear call, doing time decay over the weekend. Pretty fabulous trade to be in because technically it sets up nice. Good little opportunity here. I like it. I like the opportunity. If you look at your snapshot analysis, 34% maximum profitability. We're not looking for maximum profitability, but a 50% plus, 56% for any profit. It's a good trade. 2.5 to 1 risk to reward. It really is a good trade. Little difficult to be in right now, but if I was looking for a trade today, I would follow right in behind you. I'd follow right in behind you, and I'd give this one a go. Giving it a go just to try to get it over the weekend. Guys, have a great day. Appreciate your time. Look forward to seeing you next week, and have a good day.